Good day, good day, good day, everyone. Great to be here today, Monday, June 22nd, 2020. I'm Rob Tetrault from robtetrault.com, portfolio manager here at Canaccord Genuity Wealth Management and at the Tetrault Wealth Advisory Group. Also happen to be branch manager of the greatest Canaccord branch in the country, that is the Winnipeg branch. Today we are extremely lucky. I'm thrilled to have with us our Chief Market Strategist. I'm excited. I'm going to bring him on right away. What a fantastic couple of weeks it's been in the market. NASDAQ finished or wants to finish at an all-time high here towards the end of the day, above 10,000 points. The Dow is up again today. Pretty thrilled to have with us our macro group head, senior managing director, and our chief market strategist for Canaccord Genuity, none other than Mr. Tony Dwyer. Tony, thanks so much for being here today.
It's my pleasure, Rob. Thanks for having me, buddy. So welcome and good afternoon, everybody. So what I'd like to do is just give you a little bit of perspective about what we're thinking in the current marketplace. Let me go to give you a little bit of history for those of you that don't know me. I spent the better part of the last 11 years usually being known as the most bullish guy in the street. Earnings were going up. The market follows the direction of earnings. So in January 20th, we had thought since last November, frankly, that the market had gotten ahead of itself, so that when we got to January and the COVID started and the overbought condition was there and, you know, you had narrow breadth where just a few mega cap stocks were leading the charge, we downgraded the market to and suggested taking down some risk, which turned out to be a pretty good call. As the market collapsed, as COVID became a bigger issue, which obviously I didn't expect a 34% drop in a month. And don't forget, that was the sharpest in the history of the exchange in the U.S. That was the sharpest drop to correction territory, meaning greater than 10% drop, or bear market, meaning greater than 20% drop in the history of the S&P 500. It really was extraordinary how the COVID-19 and the coronavirus developed globally. So then you fast forward and on March 20th, frankly, we put out a note talking about how the market was ripe for an oversold bounce. And any time that it had gotten that oversold in its history, it had a median 17% gain. So I think we did a pretty good job on the turn. Where we didn't do such a great job was history had shown that any time you got that oversold, you ultimately retested the low. And what made that call wrong was an extraordinary movement of the Federal Reserve. It was really incredible. If you told the Fed that in January or in February that within a month they were going to be issuing a statement that they were going to buy corporate debt, I think you would have been laughed out of the Fed room. And again, of course, the Fed is the monetary authorities in the U.S. So the Fed on March 26th, what caused the turn was the Fed indicated that they were going to be willing, on March 23rd, they were going to be willing to buy investment grade debt. And that was a really, really important news item because they were scared that we were going into this deflationary spiral and that we were going to go into a Great Depression type scenario because the government was forcefully shutting down, globally, by the way, was shutting down the economic activity. Now, if there's ever been, you know, a picture of a crisis, that was it. So as soon as they made that statement and you coupled with an oversold condition, man, that thing ripped. And then what happened was the Fed said they were going to buy various areas of high yield debt. Wow. That is backstopping the highest level of risk outside of equities. And that turned out to be a game-changing decision, which we wrote at that time. The market then went into about a 2-month trading range. And then once you came out of that trading, what drove us out of that trading range was the most incredible 60 Minutes interview I have seen in my lifetime. In that 60 Minutes interview, I'm going to give you a chart. I'm going to show you a chart of how this all progressed. Here on this slide, you can see this is, you know, around January when we downgraded it right up here. You went into the COVID-19 collapse down 34%. You got your initial move off the low. And on April 9th, the Fed said they were going to buy high yield debt. That meant you weren't going to retest the low. You certainly shouldn't. You took the worst case off the table. The 60 Minutes interview came in this gap that's right here in between, right before you broke out of that trading range to the upside. That 60 Minutes interview is really important because historically you always had Ellen Greenspan, Ben Bernanke, Janet Yellen talking about how the deficits were unsustainable and you can't have deficits forever. So any monetary easing is going to be temporary. Well, Fed Chair Powell came on 60 Minutes. He literally used the term, the statement, we are printing money. We're just printing it. Like, there's no quantitative easing. There's no buying of treasuries. There's no other. He said, we are printing money. And then when the anchor looked at him and said, well, how is that going to end? He goes, now is not time to worry about what those consequences are. So ultimately, we have a Fed that is hell-bent on moving money back into economic activity and risk. And this presentation is going to walk you through what that means. So the first thing that the Fed is most focused on, there's a dual mandate at the Federal Reserve. That dual mandate is to get full employment, which roughly means 4% unemployment. It's currently 13.3, one of the highest in history. Again, you're not getting to full employment for at least another year and a half to 2 years. And then the second mandate that they have, which is descripted here, is the core inflation rate. They want core inflation on a year-to-year basis to average 2%. As you can see here, it's below 1%. So I don't know about you, I'm not that good at math, but I know that 1% is below 2%. So the Fed is going to stay easy for a very long time, as long as this inflation reading is below that dashed black line on the top. Then if you look at what that means, how do you gauge with all this money printing? Isn't there going to be inflation? Isn't that going to be a really tragic outcome? And the answer is probably. But at this point, you only have to look at the U.S. inflation break-evens on a 10-year basis. In this chart you see in front of you, it shows you again what the inflation break-even rate. It's going to be interest rates against inflation. The inflation break-even rate, looking out 10 years, is about 1.4%. That is not exactly a high inflation. It's actually still deflationary. So what they have is they have inflation that tells you that it's way below where they want it on this line I just showed you, right? And they've got to tell you in 10 years from now, it's still way below that 2% level. So if you're the Fed, you're pretty scared, and you're going to bring interest rates into negative territory. So in this chart here, you have higher lows, because the more debt you have, as soon as you bring up interest rates, a house costs so much more today, so you need a lower interest expense to be able to afford it. So what the Fed has done is they've actually initiated long duration periods where you had a low real Fed funds rate. In other words, they're going to keep interest rates in negative territory because of inflation, low inflation, because the 10-year inflation break even is still historically low. They're going to keep rates in negative territory. What that means is you're probably going to keep the yield curve steep. And what happens on the yield curve, that green circle tells you currently where you are. The yield curve is rising off of that inverted territory it had prior to the recession. Again, we can absolutely say every time that you've had an inversion of the yield curve, you've had a recession shortly thereafter. Again, that's been proven true. That inverted last August 26th, and we highlighted it at that point. But now you're on the road to recovery, which is typically what happens as you move through a recession, clearly the case here. And then, so what does that brings you to the point where you've had an extraordinary improvement in corporate credit. There has never been a time where you've had over $1.4 trillion of corporate credit new issuance. The Fed, when they backstopped corporate credit, meaning, companies that issue debt, when the Fed said, we'll buy that debt, all of a sudden, every company that could in America went to the debt market and started issuing debt at historically low yields. So you have this point where there's the economy slowed down, but think about that kind of money going into corporate coffers. And of course, it's to bridge the gap between the economic shutdown and the economic reopening. But you have a real problem economically and in the market over time when you have a need for money as a company or a household, frankly. You have a need for money, but don't have any access to it. All it took was the Fed to say, we'll buy it. They didn't even buy much. They bought, I believe, last I checked, it was under $10 billion out of a $250 billion program. So they haven't even scratched the surface yet, but it's generated $1.4 trillion of corporates raising money. It's a lot of money they can spend, and it helps you certainly helps you bridge the gap. So when you look here on this slide, this is financial conditions. Now, this is a spaghetti chart that I use in my presentations. It's called the National Financial Conditions Subindices from the Chicago Fed. Those squiggly lines tend to move together, as you can see. When they're moving up, it means you're in tightening financial conditions. When they're moving down, the opposite is true. You're having easier financial conditions. What the Fed did that's different than 2008 and took that kind of crisis off the table, every time these guys see something, they attack it. Every time they see a problem in credit, they go after it. You know, it used to be that the Fed would have a meeting to have a meeting. They'd talk about it. They'd do a few studies about it. Then they'd have another meeting. And then they'd figure out if they were going to take an action. This Fed is aggressive. As soon as they saw credit issues, they attacked them. And that allowed for, even though you had the worst economic data since the Great Depression or certainly the Great Financial Crisis of 2008, you still never got to the tighter financial conditions. I mean, anything could still happen, but you haven't gotten to the point of tighter financial conditions you did back then. The good news is that, well, what that led, tighter financial conditions can be seen in bank lending practices to small and large businesses, which obviously tightened into the second quarter. We believe that that prior chart I just showed you suggests that this will have peaked as well. And if that's peaked, you don't see a time here where it peaks and stay peaks. Once it hits a high, it starts to improve. And that's the period that we think we're in. We're in the improvement period. We're coming off the worst level of economic activity in the history of the country because you got low inflation, no signs of inflation. The Fed is literally printing money. Companies are going to the market and literally printing money via corporate debt. And look at what it's doing to money supply. I mean, this chart that you're seeing in front of you goes back to 1940. This chart shows you that money supply growth, M2 in the U.S., on a year-over-year basis is blasting through any prior growth period. It is not a bad thing when you see M2 money supply expanding like that. And to give you a little bit of context on that is a very cool chart that I found, which is excess liquidity. Excess liquidity is when the Fed is producing, or there's more money being produced, no matter what angle it's coming from. There's more money being produced than is needed for industrial production. In other words, for economic activity. It's excess liquidity on top of economic activity. That red line on the bottom shows you the growth rate in that, the year-to-year change in excess liquidity. And what you see is all those lines and arrows, they show you points on the S&P 500 where excess liquidity peaked at a very high level after being negative. And as you can see on that chart, unless you're a trader type, those were not bad times to be a buyer. Even back in 1971, you still had another 2 years to go before you hit a peak. It is generally, could you have a correction? Hey, we're in the correction camp right now, which I'll tell you about in a minute. But consolidation more than correction. But at this point, there's so much liquidity, I don't see how it turns into another crisis. Again, a crisis happens when you have a need for money and don't have any access to it. This chart here, this chart here is the Citigroup Economic Surprise Index. It's never hit a level that it saw last week. In its history, it has never seen a level that it saw last week. At 145, it's just incredible. It shows you how negative expectations got because, well, we shut down the economy, and that's what's going to happen. Historically, it's a good sign for the market when you have excess liquidity. Well, to just rant a little bit more, low inflation, super easy Fed, printing money, no signs of inflation, so much liquidity, and now you're surprising to the upside in the economic data. No wonder Rob's comment that the markets are doing well. And we think they're going to continue to do well over the course of the next year. And you're seeing that through, you saw a historic spike in the unemployment rate, which saw a small improvement. We're going to get another reading of that in another week or two. You're getting, Small business optimism. This is the NFIB Small Business Optimism Index. Of course it tanked when you shut down economic activity and went into a recession. However, you're seeing a bounce there. Again, a bounce better than most people thought would happen. Then you've got, we have the millennial demographic. So if most people would have said 2 or 3 years ago that the millennials want to be in the city, they just want to have Uber, they don't want to have any responsibilities outside of the city. That's not true anymore. There's bidding wars everywhere in the tri-state area. There's a neighbor of mine. They didn't even get anybody to walk into their house for 2 years. They had a bidding war last week. And the reason is everybody wants out of the city. The millennials are just turning 30. That's the home ownership and household formation years. So when you're looking at that on a slide, that's what it looks like on the red line below. The home ownership rate is continuing to trend significantly higher off of a generational low coming after the financial crisis. People want to go into homes. They want to create a home. Hell, when I was 25, I lived with 2 other guys in a 1-bedroom apartment. When you're coming out of college, a lot of folks are that way. When I met my wife, it all changed. I wanted to create a household of my own. Even globally, things are starting to bottom out. This is the breadth of purchasing managers index, PMIs they're called, and it's a measure of manufacturing activity that is positive year to year. On the top slide, that is the percentage of PMIs showing year-over-year positive change bottoming. On the bottom, new export orders are also bottoming. Again, the liquidity is helping it, and of course, reopening the country is helping this whole thing turn. The country. Reopening the world. We're all doing the same. We're all in the same boat on this one. And then on the OECD, which tracks 36 global economies, you're seeing the same thing. You're hitting on the top chart, the overall share of composite leading indicators for the 36 OECD countries. It's at the worst level since 2009. But look at that orange line. The month-to-month change is ramping just like it did coming off of the low of 2009. So what we're left with is earnings per share getting better. It should bottom out at 125 or so this year. Next year is 150. Excuse me one sec. Next year, our estimate's 150, and I think that's too low. Frankly, I don't know what number to put on it because you're having such a strong growth in money supply and excess liquidity. It should be more significant than most people think. I'm too low on that number. And then if you look at the trend of earnings, all three, the gray bars are net income, black bar is revenue, and blue bar is earnings. They're trending higher through the second quarter of 2021. Accelerating higher through the second quarter of 2021. No kidding. We had the worst quarter in history in the last quarter, or in the current quarter. And then it trails off from there, but still pretty solid growth. So again, similar to the last cycle, we're expecting a lot more than just one good recovery year. So where are we in this whole, the correction idea and the whole overall market view? So we had the bounce off the bottom, went into a trading range. Historically, when you're in a trading range environment, you take the spread of the trading range, add it to the breakout point, and that is your target. Market hit our short-term target of 3150 because it broke out at 2950, so our target was 3150. And at that point 2 weeks ago, we suggested that that was a good place for the market to rest. I didn't think it would be a 7% drop in a week, but it was generally what we were looking for. We think that the market, anytime, this has been an incredible breadth trust market. As a matter of fact, this next slide is going to show you. This next slide shows you the time in 2009. The only other time that you got a 30% 10-week rate of change, the bottom half of that chart, the only time that's ever happened in the history of the market was coming off of that 2009 low. When you came off of that low, you had a 7.1% drop, very similar to what we just had before continuing higher. But we did find that over the course of this rally has been very, very broad. Those blue arrows on this chart signify times when more than 90% of the S&P 500 was both above the 10 and 50-day moving averages. And Forget about if you understand exactly what the indicator says. Just look at the arrows. None of them were horrible times to buy stocks. Market can, you could have had a correction, but the market continued significantly higher. In addition, those green arrows signify when 90% of S&P 500 stocks were above their 50-day moving or intermediate term moving average for at least 10 days. So a long duration breadth thrust higher. And this is one of those things that really had to skew our opinion about whether the market could go up sustainably over time. And again, it's a very good sign when you have that kind of buying. So, in sum, we think that the market, because of the gains off the low, similar to that first move off the 2009 low, we think that the market is set up to consolidate over the next month or two. And as it consolidates over the next month or two, we want to use periods of weakness to add risk. When that money supply goes into economic activity, once the economies reopen, we hope that there's a virus or a vaccine coming out soon. There's every company in the world is trying to get it to market first. Once that happens, the amount of money that can go into economic activity is truly extraordinary. And that just can't be bad for earnings. And as I opened with, the market correlates to the direction of earnings, and that should be positive for years to come. So, Rob, with that, I can turn it over to Q&A.
All right. Thanks, Tony. So there's a question here from Benjamin asking me how you're calculating your forwarded 2021 S&P earnings and how you're estimating them. You touched on it a bit. So forward 2021, how do you calculate that?
So for 2021, what I tend to do, guys like me start making up numbers. Guys and gals like me, they start making up numbers. Like, they come up with some discount. What I do, there's nobody more accurate than the consensus of analysts that follow a stock. So if you take what's called the bottom-up estimates of the stock, you basically take an over-under based on how you see the economic recovery. And as I obviously stated, I think it's going to be better. Currently, my 2021 is below that consensus estimate of 163. I'm at 150. Again, I think that's too low, and that's likely to change.
Okay. Question here about USA hotel investments. So obviously the risk on trade that's been popular with the Robinhood traders of late. What are your thoughts? Question from Carlene. What are your thoughts with respect to the U.S. hotel investments? Some of them, MGM, Hilton,
Right.
You probably know some of those stories.
Yeah, as you know, Rob, I'm not allowed to talk about individual stocks or even a very specific industry group. But as you said, it's a risk on trade. So back when the market broke out, we thought it was a good time to buy risk on. In other words, that money supply is going to end up being spent at places like hotels, casinos, airplanes, vacation resorts, things like that. Are they going to go up in the next 15 minutes? It doesn't seem like that with the COVID-19 coming back with a little bit of a vengeance in Florida, where you have Disney World. So, you could have, it's going to take more time. I'll tell you a quick story that kind of highlights what can happen with consumer discretionary space. My wife went to the dentist today. She had to have some work done. When he was there, he knows what I do for a living. He goes, tell your husband that I have 3 months of backlog. I have no free time. My business is booming. Right? That's hotels, casinos, all these things, but not tomorrow. Right? So if you're trying to do this stuff for the next week, I'm the wrong guy to ask. Count on Rob for sure and the other folks in the branch. And your advisor, talk to any advisor. I just think intermediate term with that money that's out there, it's going to go into spending.
That's a great analogy. Thanks for sharing that. Question here about Canadian to U.S. currency. I don't know if you could touch on that or what, but whether or not investing in U.S. equity stocks in RSP is a good idea for the long run at this point in time, or is it best to stay in Canadian currency and focus on Canadian stocks and Canadian currency? I think I know what you'll say, but I'll let you answer that.
I like to, honestly, hey, if you're printing money, that means you're going to get faster growth. Where are you going to get the faster growth? In industrial production. What goes into industrial production? Materials, commodities, industrial complex. Right? So that's why we believe that it's called the economic economic reopening plan. It's you want to be exposed to stocks that are going to benefit. So it's not just stocks, it's currencies, right? You want to be long commodity-based or materials-based currencies or those currencies that have that kind of backdrop. Canada would be fitting in there just like Australia would. So I think there's a good opportunity over the next year for the more aggressive, not more aggressive, the more materials-based and industrial-based currencies to do better.
Okay. Okay, you talk about, there's a question here about financial companies. Not sure if you can comment on this, but did they get blindsided by COVID? Is a question from Les. Did they get blinded by COVID? If they did know, how much before the crash did they find out? I'm not sure if specifically asking about conspiracy theory here. I think it's more of a, why weren't they more prepared with their balance sheets type question?
Well, they were. I think the banks have weathered the storm extraordinarily well, and Jerome Powell said that on the, again, I'm not speaking specifically of Canadian financials. I'm talking about U.S. financials. The banks, are still down, I think, 40% from the peak this year. And, taking into context, it's an important context. They're not at risk. It's not that banks are at risk. It's the entire economy went to risk. It was interesting. Last week, I actually noticed that delinquency rate on credit card debt, which is weekly data series, it really wasn't that worrisome. I was actually a little bit surprised that it was okay. But I do think that the banks are going to be in okay shape versus the last 3 cycles where really they were the epicenter of the problem. Remember, Rob, the guys printing the money told you they're going to backstop it. And they are. So you can fight it or you can accept it. And again, what I love to tell investors is that I'm not saying whether that's good or bad, right or wrong. It's bad and it's wrong. It is what it is. The guys printing the money are telling you what to do. All you got to do is follow what they do. You could buy corporate debt because that's what they're buying.
Yeah, it's crazy how how quickly that happened. You touched on it in your early in the early part of your presentation. With respect to printing money and the attitude that they've taken, it's almost like the future corrections. I mean, if ever we get another macro event like this, whether it's a war or a pandemic or whatever it may be, the commitment to print money is kind of going to change how we feel about the stock market's volatility, is it not?
Well, what it does is it creates a sharper crisis and a sharper recovery. Right? You had a much faster decline than you ever thought you would, and then a much faster recovery than you ever thought you would.
But
so I think it's really a function of that.
Do you think on a future event like this, the market will price in the likelihood of the Fed making that announcement?
No, because human nature always shows panic, because they could have done it this time too. And that was a 34% decline in about a nanosecond.
Yeah. So you're saying humans will be humans. We're going to see the correction,
right,
regardless if ever there's another event.
And then it creates a faster recovery because you feel like you made a mistake.
Yeah.
It's human nature.
Yeah. Okay. Question here about the huge debt. This one I've heard a lot from a lot of different people. So, I mean, it's mostly with respect to Canadian, but it can be American. How will the huge debt that's being incurred by our government impact the economy and the people's investment portfolios? I think I'd stick with the economy first, and then I have a follow-up question for you.
Taxes, right? So one of the next questions I'm sure is related to the political environment in the U.S. and whether Trump's going to win or Biden and which one's better. It won't matter. Ultimately, somebody's going to have to pay the price for all the debt, because just the sheer level of debt likely means that you can't inflate your way out of it, because if rates went up too much, it would shut it down. So the answer is you're likely to have some kind of tax legislation on corporate taxes. If Biden wins, you'll certainly have a rolling back, I think, of some of the Trump tax cuts to pay for some of the stimulus that has been provided.
Do you see the downgrading of our Canadian debt or North American debt? And if yes, increase the cost of capital for our governments, which would then make it very difficult on the balance sheets?
No, because you got the bond market in 2011 to 2013, when it was taper tantrum. It was 2011. The U.S. debt got downgraded, and the bond market rallied, meaning yields came down. They didn't go up. So if you want to look at the only time that the U.S. debt was downgraded, it actually got better, not worse, from that point. And we're at a historic low. And I'm not part of the rating agency, so should it be? Yeah, but then what are you going to do to every other country that's worse off than even the U.S. or Canada? That North America is in pretty good shape as it relates to Europe and Japan, the other two real currencies, reserve currencies. So, yeah, I mean, could they get downgraded? Could. Would anybody be shocked? I doubt it. Do you think you're going to go buy, I don't know, the Chinese yuan or the euro or the yen because of it? I find it highly unlikely.
Do you see a future where those rating agencies are rating this debt on a relative basis versus on an absolute basis, which is I think what they're likely doing?
I mean, that's a guess, Rob. What you and all the advisors in Winnipeg know, I don't guess. I like data. Guessing, I don't like to guess with other people's money. And that would just be a guess.
Okay. Do you want to touch further on Trump and Biden? What do you think will happen on that?
No, because it's not relevant. Either way, you're going to probably see higher taxes down the road.
Okay. I think that's it. I think I ran through all our questions here.
Awesome.
So I do want to thank you for your time. For those of you that are watching, reminder, this is the Winnipeg branch presentations. Clinton Orr, Kevin Becker, and myself, Rob Tetrault, we thank you. If you do want to book a consultation with any of us, for me, you can go to www.speaktorob.com. We'd be happy to have a chat with you. You could also go to our Winnipeg Canaccord Genuity site. Kevin Becker and Clinton Orr both have their own website as well. We're thankful that you took the time here today, Tony. You're a busy guy. We value your time. We will post this on our social media and on our YouTube channel and our Facebook channel. And if you are watching on the replay, please take a second and like our page and subscribe to our YouTube channel. Ladies and gentlemen, I do want to thank Mr. Tony Dwyer here, Chief Market
Strategist, buddy.
Got
it's all good.
Canaccord Genuity. And
My pleasure.
The wonderful team you have behind you that made this possible. Thanks so much. Have a great Monday. NASDAQ closed at an all-time high today.
Have a great day, everybody. Thanks for tuning in.
Thanks, Tony.